Hello, everyone. Welcome to this Fingal Chamber webinar with Forvis Mazars. And we're delighted to be joined by their experts today, and they'll be able to share some insights and brief the Fingal Chamber members on how the recent updates to the Irish tax landscape might impact you and your business. They're going to cover a couple of different areas on VAT compliance, the enhanced reporting requirements for payroll, as well as trends and updates on revenue compliance and interventions and revenue audits. Forvis Mazars are hopefully going to provide you with, really in-depth insights and updates as to what's been happening and what to look out for in the year or so ahead. And we will be able to have a Q&A with them at the end of this session if you'd like to use the Q&A function at the bottom of your Zoom toolbar. Delighted you could join us. This morning's webinar will be recorded and will be shared with you after the event if you'd like to share it with colleagues and other people within your network. You're more than welcome to do so, and we'll follow up with any of the slides as well post-event. But for now, I'd like to welcome Frank Green, who's partner with and head of tax at Forvis Mazars, along with his colleagues Kieran Ahern, director of indirect taxes, and Jeff Johnson, who's tax manager. And delighted to have you all join us. And I'd like to hand over to the Forvis Mazars team. Thanks for joining us, guys.
Thanks, David, and we appreciate the opportunity to present some topical tax matters to the Fingal Chamber. We obviously a long association with various chambers here around the country and in Dublin, and I think it's good to be able to present to the members on some key issues that are actually there. So just in terms of Forvis Mazars, because some people might wonder who they are, we were called Mazars. We're now called Forvis Mazars. It's just a change of name, not a change of substance. So we essentially have 5 offices around Ireland. We have approximately 900 staff and 39 partners. And services that in general we do is tax advisory work, audit, accounting, consultancy, mergers and acquisitions, raising of finance. So we're a broad-based accounting and tax practice with coverage right across the country. In addition to that, we are an international firm. We're an integrated partnership. And you can see there we have coverage right across the world. So whether we're actually dealing with businesses that come in from other jurisdictions or whether some of our clients who are located in Ireland need assistance and help across the world, we're able to work right across an international perspective on this into the States, down into the Middle East, China, wherever clients are actually going, we're able to provide services of a very broad nature. So that's broadly speaking just ourselves. In terms of what we do on the tax side of it, we have a team of about 100 here in Ireland on the general taxation side. That covers corporate tax, income tax, capital gains tax, capital acquisitions tax, international tax, transfer pricing, succession planning, mergers and acquisitions. So we're a very broad-based tax service, and obviously Kieran Ahern is here, which is Kieran's our VAT, one of our VAT directors, and he provides services of that nature. And as well, I'm joined by Jeff. Jeff's in the corporate tax side, and he actually does work across a range of general tax matters. He's more general in nature, and I've worked in the tax arena for quite a number of years. From a broad perspective, right across anything from property to revenue audits. For my sins, I worked for a little while in the revenue commissioners many years ago, but it just gives one a little bit of an insight into what's happening. And I think on some of the topics that we're going to touch on today, in particular to do with the revenue audits, it's useful to be able to have that sort of insight from the perspective of people on the other side of the coin. So what are we going to cover just here today? So the team that's here with me, there is a number of items that we will touch on. First up will be Kieran Ahern. So Kieran's going to give us an update on some current VAT matters, and that's broad-based in nature. Then Jeff is going to deal with the recent case, which is quite topical, to do with what's called the Domino's Pizza case, but it's to do with determining whether people are employed or self-employed, and it is actually something that's quite important and certainly links in a lot with revenue audits. So Jeff will give you his insights into that. I'll deal with the current enhanced reporting requirements to do with various benefits and travel and subsistence that's paid to people, and then we'll deal with some stuff on the revenue compliance interventions and revenue audits. Also, if people have any questions, you can put that into the actual Q&A to that part of it, and we'll pick up on that towards the particular end of it. So first and foremost up is Kieran. So Kieran, you might take it away and deal with some of the VAT points in it.
Okay, thanks, Frank, and good morning, everyone. And thank you all for joining. As Frank said, there's two topics, I suppose, broadly that I want to cover today. First is a general VAT update and a couple of bits and pieces that have changed in the last while. And later on, then we'll be looking at some of the VAT issues in revenue compliance interventions. I want to start off with an obvious VAT topic, and that is, of course, with Albert Einstein. In 1942, Albert Einstein gave an exam to his final year students in Princeton University. And after the exam was over and he was walking back to his office, his assistant, who was reading over the exam, said, "My God, I think you've made a terrible mistake here. These questions are the exact same exam that you gave to the same students last year." And Einstein answered, "No, it's no mistake. The questions are the same, but the answers have changed." Now, I imagine some of you are now saying, "Well, that's wonderful, Kieran, but I thought we were here for a tax update and not a physics lecture. And what has this got to do with VAT?" Well, quite a lot, actually. I mean, judgments from the European courts, tax appeal commission decisions, budget changes, legislative changes, update revenue guidance, and of course, anything that's based on legislation, as VAT is always open to interpretation. And what all of this means is that the answers are always changing. Those of you that get the e-brief updates from revenue will know, we're not even midway through the year, and as of yesterday, I think there was 106 e-briefs that have issued so far this year. So the kind of the recent changes or topics that I want to look at from a VAT perspective, broadly, I think I have about 8 headings. I want to look at the VAT registration thresholds, the Intrastat thresholds, the annual return of trading details, the position when there's VAT rate changes, postponed VAT accounting, partial VAT recovery, the situation with VIS returns, and then some general updated dates that are coming down the line from a VAT compliance perspective. So the first one then is the VAT registration thresholds. So they were changed from 1 January this year, and the VAT registration thresholds have been increased. So for goods, it's now 85,000, and for services, it's 42,500. So that means if you're below those thresholds, you don't have to register for VAT. Unless, of course, you want to. Intrastat thresholds also changed from the start of this year. And Intrastat, for those of you that don't know, relates to the movement of goods between EU member states. So there's statistical returns tracking the movement of goods and the value of goods and the weights of goods and what actually commodity code on goods they are. So they're tracked around Europe. Now, the previous thresholds for arrivals, so that's goods coming into the country, was 500,000, and for dispatches, goods going from Ireland to other EU member states, was 635,000. They've been increased to 750,000 for both arrivals and dispatches from 1 January this year. Now, there is a potential opportunity here if you were or you have been filing Intrastat returns based on your prior year exceeding the threshold, but you were below 750,000, you do no longer have to file Intrastat returns. So there could be a compliance benefit just by monitoring those thresholds. The next thing then is the annual return of trading details that I want to have a look at. Now, historically, this return, I suppose, was similar to the VAT 46G, in that if it fell off your desk and landed down behind the radiator, that was probably the best place for it. And historically, there was a very high level of non-compliance in terms of filing this particular return. but there was a recent e-brief, and it's outlined the consequences of not filing this annual return now. So if you fail to file that return, your VAT refunds can be withheld. If you're a subcontractor within the RCT regime, your RCT deduction rate may be increased. If you were looking for a tax clearance certificate for any particular reason, that could be withheld. And if you're in the unfortunate position of looking to get into a phased payment arrangement with revenue in relation to legacy debts, that cannot be initiated while your annual return of trading details is outstanding. So it's now becoming increasingly more important that you file this return. And in relation to the completion of the return, then, I mean, our mantra would have always been, make sure that it reconciles to the VAT returns. So therefore, when revenue take the return and they multiply it out, they get back to the VAT returns. But this new e-brief suggests otherwise. That it shouldn't and it won't reconcile to the VAT returns. And they give examples of specific places where information should go. And some of this seems counterintuitive to what we would have historically understood. But in terms of the key changes, then I suppose there's four that kind of stood out to me. One is that revenue have said that the capital goods scheme adjustment should be excluded from your annual return of trading details. Now, a capital goods scheme is a VAT payment or a VAT refund depending on the use of a property, and you would include that in your VAT return as a liability or a refund depending on what it is. But revenue were now saying that should not be included in your ARTD. So automatically you'll see that the VAT returns in the ARTD will not reconcile, but revenue have acknowledged that and they're prepared to proceed on that basis. The second thing then is exempt sales go in box E3, and that's the standard what we would have normally have expected where exempt sales would go. But there's a caveat to it where they say that unless all your sales are exempt and you're only registered for VAT in respect of services received from abroad, then you do not complete any entry in box E3. And to put an example on that, I suppose, a typical example there might be a doctor who's registered because he's receiving services from abroad, but all his other normal services are exempt. He is not supposed to complete the E3 box anymore. Intra-community supplies, that's both goods and services and exports, all go into box D4, which is your 0% rated export box. Historically, there was always a big difference between what you termed an export and an intra-community supply. But for the ARTD purposes, revenue want to put them all into one box. And finally, then, services received from outside the EU should go in section 1 rather than section 2. Now, I think, look, from a strict technical basis, there could be question marks around some of those entries and some of the places where revenue want to put it. But I think broadly, the guidance is to be welcomed because it does provide certainty, and we recommend that all taxpayers would follow that guidance. The next topic then I want to just touch on is VAT rate changes. And I suppose as a general statement, there's been an unprecedented movement of VAT rates over the last number of years, particularly in the context of the tourism and hospitality sectors, electricity and gas supplies. So, broadly, the hotel and tourism rate went from 9% back to 13.5% on 1 September 2023. Gas and electricity were due to go from 9% to 13.5% on 1 May, but that has now been extended out again for another 6 months until 31 October 2025, so later on this year. Now, we do understand that the VAT rate for the tourism and hospitality sector is in the program for government, so there may be a change back to the 9% rate. But again, it's a kind of wait and see. And based on my reading of what's in the program for government, they seem to be specifically tailoring it towards maybe the food-based hospitality as opposed to hotel accommodation. But look, it's a wait and see as to what will actually be implemented. And I suppose then just in terms of rate changes, it is, it's not just specific to those particular sectors, but in any situation where there's a change of VAT rate, from your perspective, you need to be aware around issues around updating your systems, the pricing model, the time of supply and what rate applies. If there's a change in VAT rate and you make a supply, is it the date of the invoice or the date of the supply? And you also need to be aware of how you deal with deposits and credit notes and what rate applies when there is a change of VAT rate. The next topic then is postponed VAT accounting. Now, postponed VAT accounting is something that was brought in on foot of Brexit. And prior to Brexit, if you were importing goods into Ireland from outside the EU, you only had two options really. You either paid VAT at the point of importation, or else you deferred it for 6 weeks. So there was a small cash flow benefit where up to 6 weeks credit essentially you could get, but ultimately you had to pay the VAT and then you recovered it on your VAT return. But since 1 January 2021, the revenue have introduced postponed VAT accounting as a cash flow mechanism. And what that means is that you don't pay VAT at the point of importation. You simply self-account for VAT in your VAT return, and you take a corresponding deduction if you're entitled to do so. Now, the important aspects here, I suppose, is that the PA1 box must be completed, and you must also complete the relevant boxes on the annual return of trading detail. And the postponed accounting value is the customs value plus the customs duty. So I've done out 3 examples here. We do see a lot of errors around, the use of postponed VAT accounting. And I suppose the idea giving these examples here are twofold, in that this mechanism is also the same mechanism that's used for the general self-accounting on the reverse charge basis for the receipt of services from abroad or intercommunity acquisition of goods. The procedure is exactly the same. So whether it's postponed VAT accounting or a normal self-accounting in terms of the receipt of goods or services from the EU, the same principle applies. So the first example here is someone is bringing in goods worth €10,000, and we've assumed that they have 100% VAT recoverability. So your T1 figure, which is your output VAT liability in relation to that importation, is 23% of 10,000, which is 2,300. On the basis that they've got full VAT recovery, they're entitled to take a corresponding deduction of 2,300, and your net liability as a result of that is nil. And you have to complete the PA1 box then, being the €10,000. The second example then is a business that has 40% VAT recovery. So again, your output VAT liability in relation to the import of those goods is 23% of 10,000, which is 2,300. Because they only have, the entity has a 40% VAT recovery, then they're entitled to recover €920, which is 40% of 2,300, and you end up with a liability of 1,380. And again, you put in your €10,000 in the PA1 box. And finally, then, in a situation where you have a business that has no VAT recovery in the import goods to the value of €10,000, you have an output VAT liability of 2,300. Because there's no VAT recovery entitlement, you've got zero input VAT, and you end up with a liability of 2,300, and again, your PA1 box of 10,000. But I suppose the important point there is that, when you look at the use of postponed VAT accounting or any self-accounting exercise, the methodology behind it is that you end up in the same position as if you incurred that VAT in Ireland. So if you look at the last example there with someone with no VAT recovery, they end up paying €2,300 on their VAT return. They don't recover any VAT. And that's the exact same position as if you imported goods and paid VAT at the point of importation. You pay €2,300. You're not entitled to get that VAT back. And so you end up in the same net position. The next topic I want to talk about then is just partial VAT recovery, and this crops up an awful lot as well in businesses, and it's to do with businesses that are involved in both VATable and VAT exempt activities and how you deal with your VAT recovery position. And I've seen this being incorrectly calculated in a number of cases. That a business will say, well, we're involved in exempt activity, therefore we don't have entitlement to recover full VAT, and that's strictly not correct. I mean, what you have is, if you have costs that relate exclusively to your VATable activity, then you're entitled to recover that VAT in full. If you have costs that relate exclusively to your exempt activity, you're not entitled to recover any of that VAT. And then you've got a third category, which is your dual use costs, and they refer to any remaining costs that cannot be exclusively attributed to either your VATable activity or your exempt activity. And in relation to those dual use costs, you can only deduct a portion of the VAT that relates to your VATable activity. So I've kind of summarized it then. If you want to think of it simply, you've got three buckets in terms of your costs. You've got one bucket, you put all your costs in there where you've got full deduction. The second bucket, you put in there costs that you have no deduction, and whatever's left over gets put into the third bucket, which is your dual use cost bucket. And I think that's the place where people get mistaken, where they say, well, I've limited VAT recovery, so therefore all my costs are in the bucket, and they just apply a percentage to those costs, where you have to segregate them into individual buckets initially and apply your rate or your recovery rate accordingly. And just then, in terms of coming up with the calculation for your VAT recovery rate on your dual use costs, the primary method of doing that is calculating the VAT based on your turnover method, which will be looking at your VATable turnover over your total turnover. And that's the primary method which you come up with for your calculation of your dual use percentage recovery. Now, that's subject to the caveat that it correctly reflects the extent to which those costs are used and has due regard to your total range of supplies. And if you end up in a situation where that doesn't give an accurate recovery percentage, you can look at other recovery calculations based on, say, square footage or staff or anything else where it will accurately reflect the use of your costs. The last two things then, just for my section for the minute, is just in relation to VIS returns. And again, this is something that I see cropping up a bit. There was a change made a couple of years ago in relation to the movement of goods across Europe, that in order to avail of the zero rating supply, so if you're supplying goods from a business in Ireland to a business in another EU member state, you can zero rate that supply, provided you meet certain key criteria, like getting your customer's VAT number, quoting that on the invoice, and putting a note that the reverse charge applies. But they introduced another mandatory part of that a couple of years ago, where you have to file your VIS returns to remain entitled to zero rate the supply. And if you do not file your VIS returns in relation to the movement of goods from Ireland to another EU member state, you're not entitled to zero rate the invoice, and revenue can come after you looking for the VAT that should have been charged in the absence of having filed VIS returns. The final item then is just in relation to some upcoming dates outside of the normal VAT compliance dates that are in place. The first one is the annual VAT recovery rate exercise, and this is again tying in with the apportionment exercise above. So if you've used an estimate for 2024 of what your VAT recovery rate is based on turnover, and after the year end, then your accounts are done, so you have your actual turnover for 2024. You have to go back then and recalculate that apportionment calculation to make sure it's accurate. And you may have a positive or a negative adjustment in terms of your VAT recovery. That calculation needs to be included in at latest by the May-June VAT return. So that's the current return, the May-June return of 2025. That adjustment needs to be included in there. Electronic VAT refunds. So this is refunds of VAT that a business in Ireland may incur in other EU member states. If you want to claim any of that VAT back via an EVR, that claim for 2024 must be submitted by the 30th of September this year. And finally, then, the VAT 56B authorizations, and this is primarily businesses that are export-led or supplying goods to other EU member states. It entitles them to receive goods or services VAT-free. So maybe you yourself have a VAT 56B, or a customer of yours has a VAT 56B. And the position with those is technically normally they are renewed every October. So it's coming up to that time now over the coming months where if you have one yourself, you may need to reapply for one in October. Or if your customer has one, the important thing is to make sure you receive a copy of that new cert to allow you to continue to zero rate your supplies to them. I'll hand over now to Jeff next.
Thanks, Kieran. So I'll be speaking on the Domino's case that Frank was referring to earlier. the full title, which is, Revenue Commissioners versus Carshan Limited, which was trading as Domino's. So last summer, Revenue published new guidance on the foot of the Supreme Court judgment from this case, and it set out a framework for determining employment status and to assess whether someone is a contractor or an employee. So Revenue now apply a 5-step decision-making framework in that regard, which it directly comes from the decision making framework from the case itself. And the Revenue have published updated guidance and manual that includes a number of practical examples businesses can refer to when considering themselves whether engagements are that of contracts of employment or engagement with subcontractors. So Revenue are encouraging all businesses to engage, whether they have contractors, and where they assumed that there would have been a non-employee arrangement previously, to reconsider this new framework to see if an employment potentially exists. And Revenue reminds businesses as well that ultimately the business is responsible for ensuring correct employment taxes are deducted and reported through the PAYE system. So this 5-point decision-making framework. What are the 5 points? So first is the work wage bargain, and that considers does the contract involve an exchange of wage or other remuneration for the work, and this is otherwise known as the mutuality of obligation. Then the second point is on personal service. So is the agreement that's one that requires the worker providing their own services, or can they substitute someone else in lieu of themselves? The third point is that of control. So does the employer exercise sufficient control over the person engaged to do the work, that it would be more considered an employment arrangement rather than that of a contracting one? And the fourth is all the circumstances of the employment. So you consider the first 3 points, and then considering the first 3 points, taking the bigger picture, whether the facts suggest that it is employment or that of a contractor. And point number 5 is known as the legislative context, and that sets out, considering points 1 through to 3, first, whether there's any other legislation provided that would guide the decision on whether someone is an employee or a contractor. So from Revenue's updated manual, I've taken a few examples just to set out how this works and applies. So in one example, we have Richard Plaster. He works for B Company, which is a building company, and he works on a labour-only basis. He's paid on a daily basis. He takes instructions from the site foreman, and Richard is not free to provide a substitute to work in his stead. So looking at the framework, the work wage bargain is met because he's paid daily a set fee to undertake the work. Personal service, he cannot send someone else in his place, so that one is met. 3, the element of control. There's the site foreman who can tell, instruct Richard what to do and when to do it. And considering points 1 through to 3 first, looking at 4, then all the circumstances from Revenue's point of view, and looking at the framework from the Carshan case, even if you have a self-employed contract and it's set up as though he's a contractor, if from the facts presented, it's more akin to that of being an employment rather than being that of a contractor. And as long as 1 through to 4 are met, you don't need to consider 5 to determine whether he is a contractor or an employee. So yeah, the answer is that he's an employee based on that decision-making framework. A second example is if we consider Peter, an electrician, engaged in services for B Company, and he's supplying his labour, his own materials, and his own tools. He's paid a set fee to wire each house for the building company, He does take instructions on what heads to wire next from the foreman, but there's no restriction on who does the work for the electrician. He can provide substitutes once the work gets done. So looking at the framework again, yes, there is a work rate bargain. He's being paid for the work that's being undertaken. But the second point in personal service is not met because he does have the ability to provide a substitute. So, you look at points 1 through to 3 on the decision-making framework before you consider points 4 and 5. And because 2 was answered negatively, that there wasn't a personal service requirement, Peter can be considered self-employed and not an employee based on the facts in that situation. So I'll hand over to my colleague Frank Green, who's going to speak now on the enhanced reporting requirements.
Thanks, Jeff, just for giving us some analysis on that. And I think it's quite an important area that our concepts in relation to that case there, in that there are many organizations who probably struggle with that concept of whether somebody's an employee or not, and part-time people, and the revenue are out and about looking at it. So I think organizations should do some form of review of what they're actually doing, just to see, do they need to update the manner in which they're dealing with stuff like that. So just something to be mindful of. Just on the enhanced reporting requirements, this is something that was mooted 2 to 3 years ago. Got a lot of airtime insofar as resistance to being brought in, which I can fully empathize with. To me, it's probably one of those pieces of legislation that essentially gathers information that is available there already. And I think, the burden that it's placed upon organizations is not insignificant. Bit like, I think Kieran touched on the 46Gs down behind the radiators. They're there for so long as well. And that information would otherwise be available. So the purpose of the legislation is simply to get information from taxpayers. And if you look at the nature and the 3 areas that are covered in it, which are probably quite important, it is the remote working allowance, the $3.20 a day. So who's ever getting paid that? No doubt that will be scrutinized by the revenue as to whether, in fact, those people are entitled to it. They look at, the costs that are involved in it over the year, and some of the larger ones, they'll just carry out audits on it and see is there backup information. And that's something I think to be mindful of, where an employer is actually going down that route. And a lot of employers probably have opted to let individuals, claim their own allowance, which they're entitled to do so. And at least it takes any tax risk away from them. Whereas the $3.20 a day, where it's paid by the employer, it's the employer's obligation to make sure that that's right. So it's something just to bear in mind on that first point, to do with what that information will be used for, to look through. Likewise, I think in terms of when you look at the travel and subsistence is sort of a very well recognized concept for many years, where essentially employers can pay employees travel and subsistence and other expenses, where, in relation to the work that they're doing, they incur certain expenditure. Now, just to be mindful in relation to travel and subsistence in the legislation is very narrowly defined. And in fact, it's quite small insofar as what you can actually claim in reality. It's got to be wholly, exclusively, and necessarily in the performance of the duties of the employment. And that is actually quite difficult in reality. Most of the travel and subsistence expenses that are paid are done on the basis of a revenue concession, which is guidance that's actually given. It's not actually written into the legislation in general in relation to it. So therefore, if you're ever arguing with the revenue commissioners on it, you're arguing a little bit with one hand tied behind your back, because if you go to appeal on it, they'll just operate on the basis of the legislation. So just be mindful of that. But in terms of, I suppose, the overall purpose on the travel and subsistence side of it, and what you need to do, it is about gathering information. There's significant monies that go out every year. I'd say, I just saw some figures recently where for a certain period of time, those payments reported about 1.6 billion under this particular heading. Doesn't surprise me at all. And I'd say the perception there is that they might be able to get tax on a certain percentage of that, which will increase their tax take. So the results of this is, I've no doubt there will be audits carried out over the next period of time on details of these particular payments to make sure that they are all actually within the criteria that's there. So aside from obviously the reporting requirements, the reporting requirements mean that you have to report anything. So the benefit of the payment in advance or on the same day in which it actually arises. So it's a fairly onerous piece that's actually required. So and we give some just details there as the nature of what's in. So on the travel and subsistence side of it, it's vouched and unvouched travel. So anything essentially where you pay tax free, subsistence as well, vouched or unvouched, whether it's the civil service rates or whether it's based upon an actual receipt somebody gives in. Doesn't really make any difference. Also, it covers what's called country money, which is in the main a concept within the construction industry sector, emergency travel, eating on site. So anything essentially where a tax-free travel or subsistence payment is made, that actually must be included in the return that's actually made in relation to it. And just on the small benefit exemption part of it as well, and while it mightn't be perceived as being of huge significance, that legislation links back in. So the enhanced reporting legislation that's there links back into what's called small benefits exemption. And the small benefits exemption at a particular stage was where you could give a benefit of up to €250 per annum to people. That has actually been gradually increased with various pressures and all that put on the government. And actually from January 2025, it has been increased to 1,500. So it's gone from a small benefit to, in fact, maybe a much larger benefit in relation to it. The other part that's just noteworthy on the actual small benefit exemption is that there can be 5 benefits within the year. Prior to this, you could have 2, and that was creating particular challenges. So that's it's anything that comes within that particular legislation to do with the small benefits is actually what needs to be reported. So each and every benefit has to be reported. So if you give 5 benefits over the year, then that has to actually be reported in there. And it's what is not taxable. If you actually have a taxable benefit, then that actually goes through payroll. That's actually not reportable per se in relation to it. The other thing just on the benefits side of it, or small benefit side of it, that sometimes does catch people out a little bit is what comes within that small benefit exemption. And in general, it is either a voucher, which most people would probably know. You have the one for all vouchers, you have the all go vouchers, so those type of cards, those type of ones, or an actual benefit itself. But the key criteria is none of them actually can be converted into cash. The other part to be mindful of is as well is that it only covers what's called tangible benefits. So a tangible is something that you can sort of see and feel and all that, but it does not cover other items. In fact, I looked at a particular thing last year to do with it, whether the small benefit exemption, when it was at the €1,000, where a company was proposing to pay gem membership on behalf of a group of people that they had there. I think it was costing €500 per annum. And actually, they wanted to know whether, in fact, it would come within that. And in fact, it doesn't. So if gym membership is paid on behalf of employees by an employer, that in fact is a taxable benefit. But there is a way around it, just by virtue of it, where if you actually give vouchers or multiple vouchers. So if you gave, say, the All Go card, they could use their All Go card, particularly that one, to actually pay for their actual gem membership as part of the overall part of it. So that's maybe something to be just a little bit mindful of insofar as maybe the approach that you take. But I suppose the key point there is that it has to be tangible rather than intangible, and that benefit, the revenue will look at that when it's reported in to see what it's costing. That benefit also is due to expire at the end of 2030. Now it may be renewed at that particular time. And just going back to the core, I suppose, of the enhanced reporting, that has obviously got to be done through ROS. It's got to be done based upon when the actual payments are actually made. Now, hopefully, at some stage in the future, there would be some amendments made to the number of occasions in which you have to report all of the individual benefits. It is quite onerous in relation to it, and certainly I cannot see why a once-a-year return with all that information across the three headings couldn't be done by an employer rather than the current one. So there is stuff where it's bureaucratically quite difficult for everybody to comply with it, but it's there, and we just need to be quite mindful that it's actually reported, it's done correctly, and that the right things are actually included. And you do need to realize that where you are making reports is that the revenue are going to use that information to do sort of profiling and screening, and they'll probably start at the larger ones. So just be careful and make sure that, as I say, your house is in order on that particular front. And when they do come, or if they do come calling, on a particular matter, they will look across the whole lot of tax heads. So it'll include stuff like enhanced reporting. It'll include stuff like whether employees are self-employed or not. So it's no harm just to bear that in mind. So, Jeff, I'm just going to hand back to you to deal with some stuff on the revenue audit side.
Thanks, Frank. So I'll be speaking on revenue audits and other revenue compliance interventions. Frank and Kieran will be chiming in, and then Kieran will be speaking on particular VAT aspects that have been coming up in revenue compliance interventions and revenue audits. So this is particularly topical at the moment because in May 2022, Revenue introduced a new compliance intervention framework. Basically, this is their new guide to how they run revenue audits, but it is published on their website, and anyone can access it. So we know the code by which they operate and the methods by which they will address what they perceive as non-compliance or do profile interviews to try and assess whether there is full compliance from taxpayers. So the new framework has a graduated level system of level 1, 2, and 3, and it applies to all tax heads except for customs, and any interventions that would have started and any revenue audits that would have started before May 2022, which you'd hope would be done and dusted by now, would be under the old code before this new code was introduced. So level 1 is the most basic level, and it's not meant to address non-compliance. It's more as revenue see it, supporting compliance by reminding taxpayers of obligations, prompting, in advance of deadlines falling, or just a self-check, and requesting taxpayers to do a check of their own compliance to ensure that they're satisfied and that everything is correct and in order. So these can often be in the frame of the request to self-review, so where taxpayers look at their own affairs, a profile interview where revenue will come out, or they'll have a email correspondence just to get a sense of a business, And then if businesses are in what's called Revenue's Cooperative Compliance Framework, then any intervention is under level 1, and interventions under level 1 have lower penalties, and that's the benefit of an intervention being dealt with under level 1. So profile interviews. So before May 2022, under the old system, the purpose was to appraise particular risk. So it would be initiated by Revenue. Revenue could examine documentation and records, and Revenue would decide if it needed to be escalated. But under the new code, the purpose is to meet the taxpayer, get a better understanding of the business of the taxpayer. It can escalate to level 2 or 3 where issues are addressed, but the main purpose of it is to just get a sense of what the taxpayer is doing and to support tax compliance. Level 2, on the other hand, is the first of level 2 and level 3, where Revenue are seeking to address what they suspect is non-compliance. So if Revenue, they have software systems in Revenue where they identify risk and they profile taxpayers, and if they suspect that there may be a risk, they can issue a level 2 intervention, which can be a risk review or an audit, and taxpayers are typically notified in writing from Revenue when this happens. Although there is a graduated level system, Revenue interventions can start at this level 2 or indeed level 3. So just to be aware that you're not always going to have your interventions starting at level 1. And so a risk review. So a risk review is part of level 2, and it's focused on an intervention that relates to a particular tax head or area of concern to Revenue. They're typically desk-based audits, so usually Revenue won't be calling out to the premises, similar to aspect queries under the old system. And taxpayers, when they receive a level 2, one benefit they don't have, which they would have had under level 1 or in advance of any intervention, would be the benefit to make an unprompted qualifying disclosure, which, if a taxpayer is doing their own self-review of their taxes and they identify an issue, if they correct an error, there is a lower level of penalty that would apply if a qualifying disclosure is made and it's unprompted. But where level 2 or 3 interventions occur, then the opportunity to make an unprompted disclosure is gone and you're in the prompted disclosure territory. So once a letter is issued by Revenue, there's 28 days after the issuing of the letter, typically, to when the risk review will commence. Up to 21 days from the issuing of the letter itself, a taxpayer has the opportunity to make a request for a 60-day extension in which they can prepare a prompted qualifying disclosure. And if, for example, the tax head is R&D tax credits, then that is within corporation tax. So if the taxpayer is going to make a prompted qualifying disclosure and has notified Revenue they're going to do so because they have received a notification about R&D, then because that's under the corporation tax head, they need to ensure that corporation tax as a whole for the period is also compliant, and any issues are picked up there as well. And then level 3, this is where Revenue suspect that there's serious non-compliance or tax evasion or fraud. These are in the form of Revenue investigations. Revenue investigations under the old system and the new system are broadly the same, and taxpayers are notified in writing, or under level 3 there can also be unannounced visits where Revenue suspect that there is fraud or tax evasion. So just a quick look at differences between the old framework and the new framework. So investigations, which is now under level 3 are broadly unchanged in terms of whether unprompted or prompted disclosures can be made. Level 2 audits, they're also largely the same. It's now under level 2 in the new framework, and in the old framework, unprompted disclosures cannot be made, prompt disclosures can be made. Profile interviews, which are now level 1, are broadly the same. The old aspect query under the previous framework is gone, and assurance checks are gone. They're generally just under level 1. And then the risk review was introduced as part of the new framework. So as referred to earlier, in terms of escalations of interventions, level 1 interventions where issues are identified and not addressed at the time of the intervention can easily escalate to level 2 or level 3, and they don't have to necessarily grow up the graduated system. The level that an intervention is dealt at is dependent on the facts at hand. So if at a level 1 stage serious tax evasion or fraud is identified, it would immediately go to level 3. And as mentioned earlier as well, revenue do not have to start at the lowest level. They can start at levels 1, 2, or 3 as they see fit. So some changes between the old code and the new code. So audits or interventions typically start now 28 days from the issuing of the letter. It used to be 21 days. The notice of intention to make a qualifying disclosure increased from 14 days up to 21 days. There were subtle changes in wording to penalty mitigation provisions between the old code and the new code. And then the thresholds to be published where there's a tax default also changed in the new code. So where the tax element of a settlement is under €50,000, there will not be publication. Under the old code, that was 35,000, and it also included the interest and penalties, and wasn't solely based on the tax element of the settlement. And then the new code also addressed offshore matters again. So just a snapshot of what revenue we're looking at. So obviously revenue we're issuing a lot of and providing a lot of supports on behalf of the government during COVID in terms of the employment wage subsidy scheme and the TWSS. And there was times where that was claimed incorrectly or it was abused. So there was compliance interventions on the foot of that, and there still are some, but I guess revenue would have issued a lot of those in the last year or two. Then they're constantly looking at the shadow economy, especially now in respect of the new code of determining employment status, which I discussed earlier. They have this framework for identifying where someone's an employee or not, where they may have been operating as a contractor previously. The new payroll system provides for real-time reporting, and the ERR that Frank covered, the enhanced reporting requirements, they also are in effect real-time, as the benefits have to be reported before or on them being made. Landlords, where there's multiple properties, that someone might be registered for LPT, that can often trigger revenue to raise a level 1 or level 2 to ensure that tax is being reported on any rental income that might be there. And then third-party data, so the 46G, the VAT RTD, other returns filed previously, they tried to glean data from that also to assess where they're going to start their interventions. So I'll just pass on to Kieran here to speak on
Jeff, just
VAT matters.
one quick little thing on the revenue audits, or just maybe, well, 2 points. In the context of sort of revenue audits in general, just any taxpayer, be mindful of the level of penalties and publication. That's a big risk, and the revenue, would like to see that. In some situations, you can negotiate, and what the revenue suggests may not be ultimately what's in it. So I think it's important that you do. And secondly, in relation to tax, where it is a technical adjustment, it should be accepted that no penalties and no publication should arise. So that's just maybe 2 points to be for taxpayers or companies to be mindful of, to make sure they look at, because as I say, revenue will press a particular route that they want to follow to maximize what they're getting, which actually isn't always necessarily correct, and should be looked at and reviewed. So, Kieran, I think you were going to wrap up with a couple of points on that.
Yeah, just in terms of, I suppose, VAT issues that we've seen arising in revenue compliance intervention or revenue audits, just said we give a flavour for what we're seeing there. And I suppose as a starting point and as a broad statement, I think it'd be fair to say that the interactions with the revenue are becoming more formalised, and the day of kind of informal interactions are reducing, and caseworkers are slower to make decisions as they move things on up the food chain to get decisions from their managers. One thing I suppose that I've learned down through the years is that there's almost limitless ways in which VAT errors can arise in any given business. But some of the more frequent ones, I suppose, that we're seeing in terms of audits or compliance intervention is incorrect operation of the reverse charge mechanism. And I touched on this earlier in the context of postponed VAT accounting. But also just the general reverse charge mechanism where, you know, you receive an invoice from abroad and you have to self-account for VAT. There's multiple examples in interventions where we see that not being correctly adopted. So that's one key point you should look out for. Another one, and it's very low-hanging fruit from revenues perspective, is the adjustment to input tax for unpaid invoices over 4 months. So typically, you know, if A issues an invoice to B, A must account for that VAT to revenue, and B becomes immediately entitled to take a deduction for that VAT, irrespective of whether that invoice is paid or not. So it's the receipt of that invoice is what gives the person the entitlement to deduct the VAT. So you can deduct VAT even though you haven't paid the invoice. But there was a thing introduced a number of years ago where if you haven't paid that invoice within 6 months, you've got to claw back the VAT that you claimed a deduction on. And then subsequently, when you do pay the invoice, you can claim a deduction again. As I said, it's very low-hanging fruit from revenue. And typically what you'll see is they look for a creditor's listing of creditors over 6 months to see, have you reversed out the deduction that you previously claimed. Another thing we're seeing a kind of a tightening up on is the no loss of revenue situations. And just for people that may not be familiar with it, this is a situation where you've identified that you haven't charged the correct VAT to a customer, and therefore there's an underpayment of VAT. But in situations where your customer would be entitled to full VAT recovery, you may be able to make a no loss of revenue argument. And the argument is that, well, if I charged the customer VAT, I'd have taken that VAT, paid it over to revenue, and that customer, on the assumption that they're entitled to full recovery, would have claimed a corresponding deduction. So you can file what's known as a no loss of revenue claim. Now, a no loss of revenue claim is an absolute concession at the discretion of the revenue, and it's up to the taxpayer to prove that it applies. And we are seeing revenue taking a more stringent approach, and they're looking for letters from the customer to say that they are entitled to full VAT recovery. And I am aware of one situation where a no loss of revenue was denied on the basis that the customer had outstanding VAT returns, and revenue said, well, because there's returns outstanding, they're not entitled to a deduction. No, there was other issues in that particular case, but you know, I suppose my point here is that, look, I don't necessarily see a problem with no loss of revenue. I still file a number of them for taxpayers, but in certain circumstances, particularly if it's part of a bigger disclosure or if positions are becoming polarized with revenue, it just may not be the silver bullet that you anticipate it is. Another key point that frequently crops up is just the importance of correct invoices, both from the sales side and the purchases side. From a taxpayer's perspective, there's only one right enshrined in the EU VAT directive, and that's the right to deduct VAT. And that right can only be exercised by being in receipt of a valid VAT invoice. So from your sales point of view, you need to make sure that you're issuing valid VAT invoices to avoid revenue coming after you and looking to charge penalty for incorrect invoicing. And from the purchaser side, nearly more importantly, you need to make sure that you're in receipt of valid VAT invoices to exercise your right to deduct the VAT that's been charged to you. Two other things then, I suppose, just importation of goods. We're seeing numerous errors with the completion of customs documentation in relation to the importation of goods, and this is obviously ramped up post-Brexit with goods coming from the UK now being subject to customs procedures. There is increased scrutiny from revenue in this area, and it's a continued focus for revenue divisions. And they are ramping up audits and checks on customs declarations, specifically around preferential origin claims and correct tariff codes and customs valuations being reported. I did read there was a tax appeals case which I read yesterday. I think it was only published in the last couple of weeks, where a transport company and logistics company that was involved in importing cars from the UK into Ireland for garages. Now, they weren't selling the cars themselves, they were just acting as the transport agent, and they were also completing the paperwork. Got stuck with a 1.2 million customs hit at the Tax Appeals Commission a couple of weeks ago. Now it's being appealed to the High Court, but and it was all around incomplete paperwork in relation to customs documentation. And finally, then, just one last point, I suppose, is just property transactions. Property transactions from a VAT perspective are not kind of within the scope of what we were talking about today, but just given the value of transactions, there's always a higher VAT risk in terms of property transactions. So the one key takeaway, I suppose, I would give you is that if you are involved in any property transactions, be it property sales or purchases, or even renting out property as a landlord or a tenant, make sure you get VAT advice on the specific transaction.
That's great, guys. Thanks so much for that. A bit of everything in there, starting with Einstein and talking about Domino's Pizza and everything in the middle. A really comprehensive presentation. A couple of questions. Kieran, I might stick with yourself. I think you might have raised this a little bit earlier, and you've covered a few of them I had around the common VAT compliance issues that emerged there at the end. Around Brexit and the kind of I suppose, advancements of talks or initial agreements this week. Do you foresee that having VAT implications at some point in the near future?
Probably down the line, potentially yes, depending on what actually comes out of it. As it stands, the agreements that came out during the week hasn't changed anything substantially from a VAT or a customs duty perspective. But that may change. I think I'm in constant communication with my colleagues in the UK, and the joke at the end of the calls is always, well, sure, give it a couple of years and you'll be back in anyway, and things are kind of heading that way with the kind of the trade agreement that's been reached again. But it's kind of, it's hard to know what may come down the tracks, but as it stands, the agreement that was announced doesn't change anything from a VAT or a customs duty perspective.
Great. And then the hospitality, I know you kind of suggested, they've moved the 13.5 to 9%. What effect did you see that happen before when there was that change in the market? And then also, do you think it is simple enough or manageable enough for them to be able to split that into kind of accommodation and food and beverage operations as separate?
Yeah, I'll take the second part first. Maybe I think it's going to be very hard to try and separate. I think, and I don't even know if it's what's actually going to happen. But I think the suggestion in terms of reading the program for government or what's been said in it is that they may look at reducing the VAT rate for food geared hospitality. So maybe your cafes, your restaurants, but not necessarily covering the accommodation side of it in hotels. And I think the problem area is going to be how they try and address, issues around, well, if you now have a hotel and you're charging for bed and breakfast, or you're having an evening meal and you're staying the night, it is very hard to try and segregate the costs and have one VAT rate for one part of it and a separate VAT rate for another part of it. And I think the risk area around it as well was it can lead itself to, when you're dealing with two different VAT rates, there could be questions about, well, if we push it all in as food rather than accommodation, you may get a lower VAT rate. And it does lend itself to, I suppose, potentially dodgy
Circumvention, yeah.
dodgy reporting. Yeah, and I'm not saying that that's the case, obviously,
Yeah.
but I think that was a concern from the revenues perspective anyway, was segregating that could lead to issues. In terms of the first part of your question, then I think look, the reduced rate did obviously help businesses get through COVID at the time, and when the rate went back up, it's obvious that it has a knock-on effect to them, because they don't seem to be able to support themselves at the moment. I mean, the number of cafes, pubs, restaurants that you see closing on a daily, weekly basis is absolutely frightening. So there's no doubt that the VAT rate helped. I think it doesn't help that there was a number of other aspects came in as well. There was the increase in the minimum wage, and a lot of things hit them at the one time. The increased energy costs as well. So there's a number of factors that are in play there. So absolutely, it did keep businesses open when it reduced, and the corollary seems to be the case when it went back up. So I think from the trader's point of view, it would be very welcome if it moved back down to 9% again.
Great. Thanks so much. A couple of questions then on kind of the revenue compliance side of things. Are there specific sectors or business sizes that are kind of been targeted in those audits, and what are you seeing coming up frequently in them?
But just on that point to do with the sizes, there's different areas within the revenue that deal with different sizes of business. So they'll all have their particular focus, and they do focus a lot of resource on the bigger players. Now they do it in a slightly different manner. It's very much done through the cooperative compliance framework, where self-reviews are done. They get as much money out of that, and you don't see it in, because everything isn't that they receive is not shown, in the Irish Independent or up on their website. Those are the ones that are essentially are published or need to be published. So the cooperative compliance framework gets that. But a lot of the stuff that they're currently looking at, I mean, there's no doubt about it. There is a focus on the issue of employed versus self-employed. That's certainly an area. The property sector, their view on that is there's a lot of activity, and there will be a lot of activity in that market out over the next period of time. So anything to do with that, whether somebody, RCT employee, versus self-employed, foreign contractors, coming in, all of that is a focus that they have. And then obviously the sectors where, historically they're always interested in anything to do with a return to, cash business. And unfortunately, there are sectors that historically have issues in that regard. And there is an element of that that's possibly there again, where for various reasons, people, there's very high personal rates of tax in Ireland, while corporate tax is relatively low. Personal tax is very high, and that can actually lead to that. So it's that broad, I think, constituent of stuff that they look at.
Great. Can I finally then, before I let you go, can I ask you if you got any kind of top recommendations for businesses who want to ensure that they stay kind of tax compliant, given the changes that have emerged, but also how things have just changed over time and in the different standpoints that revenue have taken?
Yeah, I think that what I would suggest to businesses are that they carry out proper self reviews across different tax heads, on a reasonably regular basis, not too often. Like, you do have some larger organizations who will have an internal audit function, and they will actually carry out, risk assessments to include tax as well. And I think that's actually a very good idea. So that concept of just making sure that you're on the right side of it. The other area would be, analyze the key tax risks within your organization. In general, corporate tax is probably not directly a risk. Biggest area of risk that people will come across is PAYE, VAT. If you're within RCT as well, or maybe certain types of organizations who have other withholdings, and it's the critical part of this. I think the self review or reviews, where you make sure that you actually give the right degree of input and resource. I mean, that's the other thing I think with organizations, it can be a bit of a challenge where they don't actually have that sort of tax technical resource. And they'll have accountants working for them. They'll have all sorts of people. They may not have tax resource. And that sometimes means that the interpretation of tax law and how you treat stuff can be probably just a little bit misaligned, because certainly when the revenue are now coming out doing audits on most sizes, bar the smaller organizations, but mid-sized companies, they're asking a lot of questions around, what are your practices? What's your procedures? What's your policies? So it's very much a slightly different focus to manage risk by virtue of looking behind the organization, seeing how are you structured, how are you organized, who's taking responsibility, who's looking at VAT, who's looking at POI, how do you do it? Which is quite a good way of looking at it. And they've learned a lot of revenue here in Ireland from other bodies. So I think those would be the key takeaways that I would have for any clients that we have or anyone else externally, just to be mindful of.
Excellent. Thanks so much for that, Frank. And thanks to Kieran and Jeff as well for your contributions this morning. And we're delighted to have you, and we'll hopefully have you back again soon when there's new emerging updates to brief members on. Thanks again so much for your time.
You're very welcome.
Thank you.
Thanks, David.